Imagine this. Gold futures suddenly spike above $5,000 an ounce, a level that hadn't been touched in months, and the market collectively pauses, recalibrating. Traders are squinting at screens, central banks are quietly adjusting reserves, and geopolitical analysts are scrambling to interpret the signals. The catalyst? A subtle but powerful movement from Taiwan, where institutional investors and major banks are quietly reinforcing gold's role as a core reserve asset. It's not a headline-grabbing story in the West yet, but in financial circles, this is a seismic shift. When a market as sophisticated as Taiwan signals that gold isn't just a hedge, but a strategic necessity, you pay attention. The market isn't panicking yet, but the positioning tells a story of underlying tension. Futures are rising, retail interest is slowly climbing, and physical gold demand is firming in a region that understands risk more acutely than almost anywhere else. For global investors, this is an early warning. One that suggests gold may not just be climbing, it could be entering a structurally higher plateau. The markets rarely move this way without a deeper narrative driving them, and in this case, it's a mix of geopolitics, currency uncertainty, and institutional repositioning. Watching these subtle movements now could be the difference between reacting to a surge and being caught flat-footed. Gold isn't just reacting to events. It's reflecting a calculated, forward-looking risk assessment from actors who control billions in reserves. And the lesson here is clear. The whisper from Taiwan is louder than any headline you'll see in the mainstream financial press. Understanding it could give you the insight to anticipate the next major shift in precious metals markets, while others are still debating whether the move is meaningful. This isn't just a story about gold in Taiwan. It's about risk and value across the global financial system. When institutional actors in Asia start buying and signaling gold, it ripples outward. Gold isn't just a commodity. It's a benchmark for global trust in currencies, central banks, and political stability. Rising gold demand can indicate that local investors perceive instability in fiat currencies, and that perception can quickly influence global markets. If gold continues to climb, it puts pressure on bond yields, impacts currency trades, and even drives the allocation decisions of sovereign wealth funds. Retail investors watching from the US, Europe, or other regions might dismiss Taiwan's moves as a regional story, but markets are interconnected. Futures traders, ETFs, and arbitrage desks will react in real time, and those reactions affect liquidity and volatility everywhere. Inflation hedges, safe haven allocations, and portfolio insurance strategies are all influenced by these signals, meaning a decision in Taipei can cascade to New York, London, and Singapore within hours. And the stakes aren't just financial. The macroeconomic implications are serious. Rising gold can signal weakening confidence in central bank policies or anticipation of currency devaluation, which in turn affects interest rates, lending, and global trade flows. Investors holding large currency-denominated debt or overseas assets are particularly exposed. If this movement continues, it could accelerate shifts in reserve allocations globally, making gold not just a hedge, but a key driver of macro positioning. In short, ignoring Taiwan's signal is not a matter of local concern. It's a potential systemic indicator. Those who understand the stakes early can position themselves for protection, while those who overlook it risk being caught on the wrong side of a structural shift in the global financial system. The actual trigger is subtle but powerful. Over the past several weeks, COMEX gold futures have consistently tested the $5,000 per ounce threshold. Each dip below that level met with aggressive buying, pushing prices back higher, signaling a critical structural support. At the same time, reports from Taiwanese banks indicate a notable uptick in institutional buying, particularly of physical gold, alongside a shift in advisory messaging to retail investors. The combination of paper futures resilience and real-world accumulation is what makes this event noteworthy. Prices aren't just moving because of speculation. They're moving because institutions that manage tens of billions of dollars are actively reallocating assets. The physical demand in Taipei and surrounding markets is climbing, while the futures markets are showing concentrated long positions that reinforce technical support levels. This dual signal, both paper and physical, acts as a coordinated market whisper, telling anyone watching that there's a structural narrative forming. It's rare to see both elements align so clearly without triggering volatility. Add to that the backdrop of geopolitical tension near the Taiwan Strait and currency instability in emerging markets, and the trigger becomes more than just a price move. It's a confirmation of deeper macro positioning. Analysts monitoring flows into bullion ETFs and local trading platforms are seeing numbers rise steadily, suggesting that the market is preparing for higher levels rather than reacting to temporary spikes. The technical setup is clear. Holding above $5,000 solidifies a base for potentially larger moves. What just happened isn't dramatic in isolation. It's dramatic when seen in context of positioning, physical accumulation, and geopolitical sensitivity. That's the kind of event that can quietly set the stage for weeks of upward pressure, long before the broader market catches on. The mechanism behind this movement is a combination of macroeconomic pressure, institutional hedging, and geopolitical risk. First, consider central bank policy. In the US, real yields remain historically low, meaning the opportunity cost of holding gold is minimal, and in some cases negative. Inflation uncertainty remains elevated globally, encouraging reserve managers to diversify into hard assets. At the same time, geopolitical tensions in East Asia are heightening risk premiums. For institutions in Taiwan, gold is not just a hedge against market volatility, it's insurance against regional instability that could impact currency value, trade flows, and credit markets. Then there's the supply-demand imbalance. Mines cannot expand output overnight, recycling has limits, and central banks have been accumulating record volumes over recent quarters. This means physical gold is scarce relative to institutional appetite. Futures markets reflect expectations, but they also amplify movements because positions are leveraged and highly liquid. When you combine all these factors, low real yields, geopolitical risk, constrained supply, and institutional accumulation, you get a structural mechanism driving gold higher. It's not hype. It's arithmetic and incentive alignment. The price moves we're seeing are not speculative bubbles. They're rational responses to risk and scarcity. Paper markets signal short-term sentiment, but physical buying locks in longer-term structural trends. That divergence explains why prices can move steadily upward, even if the broader economy shows mixed signals. Understanding this mechanism is critical. Gold's current momentum is not just reactive, it's preventive, driven by actors who anticipate risk before it hits headlines. The market is essentially saying, prepare now, protect value, and allocate accordingly. While gold moves are a financial story, they're a human story too. When institutional investors pivot heavily toward gold, the ripple effects touch businesses and individuals who rely on credit, trade, and currency stability. Companies importing raw materials priced in US dollars can see input costs jump as local currencies weaken. Exporters might face reduced competitiveness if safe haven buying strengthens the dollar or devalues their local currency. On the household level, rising gold demand often coincides with increased consumer anxiety about inflation and savings protection. When central banks tighten to counteract inflation, borrowing costs rise, mortgages get more expensive, and businesses delay investment. The impact is compounding. Rising gold signals risk, which spurs protective financial behavior, which in turn can reduce liquidity in other markets, creating pressure on credit and trade. For small and medium businesses, that can translate into delayed projects, higher operational costs, and reduced profit margins. For families, it can mean tighter budgets, more expensive loans, and an increased reliance on cash and hard assets. The human impact is subtle at first, but over time these shifts in behavior can cascade through the economy. When markets start reallocating towards safe haven assets like gold, it's often a sign that systemic risk is rising, not just for investors, but for everyday economic activity. The first compounding crisis is currency volatility. As institutional and retail investors pile into gold, local currencies face pressure. In Taiwan, the new Taiwan dollar has seen increased swings relative to the US dollar because foreign exchange markets anticipate potential instability. This volatility doesn't exist in isolation. It ripples through trade, investment, and pricing mechanisms. Businesses that rely on imports of technology, energy, or raw materials priced in foreign currencies are effectively paying a premium. Consumers feel the impact indirectly through higher prices on goods and services. Institutional portfolios also shift. Managers reduce exposure to weaker currencies and increase allocation to hard assets, reinforcing demand for gold and exacerbating currency stress. This feedback loop is a textbook compounding crisis. The initial risk signal from gold accumulation triggers protective behavior, which then intensifies the very pressures that created the signal in the first place. As volatility grows, central banks are forced to intervene, often adding more complexity to market dynamics. Investors and businesses that fail to anticipate these compounding effects may find themselves exposed to rapid swings in operational costs and portfolio values. The second compounding crisis is liquidity strain. When physical demand for gold outpaces supply, and futures markets react with leveraged positions, liquidity can dry up in both bullion and derivative markets. ETFs, trading platforms, and bullion dealers experience tight spreads, delayed settlements, or sudden premiums for physical delivery. Institutional investors that were counting on paper markets for hedging may find themselves forced into physical purchases at elevated prices. This exacerbates upward pressure on gold and reduces overall market flexibility. Financial systems relying on short-term lending, repos, or cross-currency swaps may also experience friction, as collateral values become volatile and risk premiums rise. The result is a systemic amplification. A movement that begins as a hedge morphs into a structural constraint, where liquidity and accessibility of assets become limiting factors. For investors, the lesson is clear. Timing, delivery mechanisms, and physical availability matter just as much as paper positions in today's environment. The interplay between supply constraints, leveraged positions, and growing demand creates a second layer of risk that can intensify rapidly, catching many market participants off guard. On a national scale, these dynamics are not trivial. Taiwan's gold accumulation and rising local demand act as a geopolitical and economic indicator for the broader region. Other East Asian markets are watching closely, and movements here influence decisions in Singapore, Hong Kong, and beyond. National financial policies may adjust in response. Foreign reserves, interest rate policy, and trade agreements can all be influenced by perceived risk in one economy. When a country demonstrates strategic accumulation of a hard asset like gold, it signals to other nations that reserves are increasingly a tool of security, not just financial optimization. This can trigger competitive accumulation, regional hedging, or even policy interventions, amplifying the effect across borders. Investors in the US, Europe, or emerging markets can see indirect impacts. Currency pressure, commodity pricing, and interest rate expectations all shift. The national story is bigger than Taiwan itself. It is a bellwether for how East Asia perceives risk, trust in fiat currency, and the strategic role of precious metals in safeguarding economic stability. Ignoring these signals could mean missing the onset of a broader, structural financial realignment in the region, and potentially the world. The message is clear. Gold is no longer just a hedge. It is a strategic indicator of systemic risk and institutional positioning. Taiwan's actions, subtle but calculated, are signaling a structural shift in how markets view hard assets, currency stability, and geopolitical exposure. Futures markets, physical accumulation, and institutional positioning are converging, creating conditions for sustained upward pressure. Investors, businesses, and households alike should take note. This is the kind of structural story that unfolds over months, not hours. But those who recognize it early are positioned to act, while others react too late. The broader lesson is about awareness and anticipation. Markets communicate before crises emerge, and hard assets like gold are often the first to reflect underlying stress. Watching technical levels, central bank flows, and regional demand signals provides insight not just into price, but into the evolving architecture of global financial risk. Those who see the whisper in Taiwan today will understand the warning for tomorrow. Gold is sending a message. Pay attention, interpret the signal, and prepare for the potential shifts that could reshape portfolios, policies, and economic confidence worldwide.